Hey everybody, this is Jose Blasco. We're about to get started. Sound check, as always. A quick message on the chat box, please. So I know you hear me well. A quick hello, as always, we do. Plus, it's a nice thing to do, isn't it? So please go ahead and do that, and that way I know we are ready to begin. Joanne, very good. uh, Wonderful, wonderful, wonderful. And Jeff, we are now commencing the session. So yes, you are in the right place at the right time. Wonderful. So 10 seconds to go, and we are going to begin the session for today. That's it. Top of the hour. Welcome, everybody. January 20, 2022. This is Jose Blasco. This is Options with Options. Today, we are getting together to analyze the markets from an options perspective, looking at market opportunities using derivatives, more specifically, calls and puts, and all those different beautiful combinations. That's why options give you options. Lots of fun. Before we get started, disclaimer. I am highlighting the disclaimer on the upper left side of the screen. Please read it carefully because it is important information. And on top of that, it's not that long to read, so I am counting on you to read it completely. Thank you so much. With that said and that done, it's also time to look at the agenda for today, which is normally the same structure, isn't it? We're going to be looking at the market, then review the trades that we have running, talk about trade management, if anything needs to be done. And from there, we're looking to identify new opportunities and putting those trades in the market. Mark, good to see you, and good to see you, everybody. Very nice. Here we go. So now, little highlight here. As you probably remember, there is a page, okay, which is important for you to know. It's, in my case, tradewithufos.com/Jose. In the case of Becky, it would be /Becky. In the case of Josip or Boyan, /Josip/Boyan. In the case of Pedro, /Pedro. You got it? And what that page does is it brings you to this place where you have a Q&A page. I mean, of course, you also have the apps. We actively use Top, the Tradictive Options Planner, as a platform. You can certainly come in here and subscribe monthly, yearly. You got courses that come with it. You got coaching as well. All of those things. Okay, you can just look at this on our site. But then, most importantly, you also have the question page here, the question section, where you click on the purple button that allows you to log in. Once you log in, you can then click on the ask question and you can phrase your questions or anything you need to be supported on. Of course, the beauty of this tool is that is a tool for the community. So I would recommend that before you post a question, you search, because maybe the answer is already there waiting for you, as we are growing this with more and more interesting content. Okay, so do that. And that way you can be supported for sure. If you need to send an email to us, you can obviously do that too. With all of this said, it's time to look at Top, look at market data, look at market conditions, understand what we have in our hands, so we can begin planning those trades properly. Okay, I'm looking at the chat box. Everything seems to be okay. Everything seems to be under control. Let me get rid of that link out of the screen because we don't need that. And again, with all of this said, let's begin. Okay, so what do we have with the S&P? Well, we have a down climate, which is confirmed. We're talking about 4 out of 2. So again, same comments I mentioned yesterday apply. From a duration point of view, this climate is closer to approaching its statistical end versus the beginning. So we should see a change of climate relatively soon. Yesterday, the market, when we had the session, the market was trading somewhere here. And then in the second part of the session, if you wish, so the market dropped by a nice additional stretch, which got our ATR spread up to all the way 180, where 2 standard deviations of what we define as too far too fast is 0.89. In other words, this market has been dropping really, really aggressively to the downside, given the nature of these markets and the statistics that are reported. So that even more, adding to what I said yesterday, now today, even more, the odds are for the market to turn. And at least so far, we got 1.51% up of price movement to the upside, which, you could, again, in an aggressive way, if you wish, you could have sensed this was coming or was likely going to come. Today we get to see a bit more evidence of it, even though the climate has not officially changed from red to blue. So let's not be too excited, okay, in the sense that a climate could continue expanding itself, okay. So let's keep that in mind. Now, there are many things in our favor that makes today look way more bullish than yesterday, which is the fact that we also have a long-term Elliott wave turning point. If that new wave expands the way it's supposed to expand based on stats, we are talking about reaching like 485 or something like that. If we were to put in here our speed bump, so potential for the S&P when start traveling above all-time high is to reach at least 487, 488. Okay, so that is out there, and this is indeed an opportunity as this new wave begins. Okay, again, it could certainly fail, but more often than not, obviously these analytics are helping us. So that's the market condition that we have. Okay, and also adding to the bullish sentiment. Okay, as an average, implied volatility for the calls is above implied volatility for the puts. That is a good thing to see. And also, when it comes to looking at the volume map, we can see that things are reversing a little bit. Yesterday, we saw plenty of put trading on the front week on January 21st. Today, we can see how this has reversed, and now it's calls. Okay, the put is barely reaching the average. The puts are barely reaching the average. The calls are way above the average. So indeed, all market data that we can assess today is indeed way more bullish compared to yesterday, and it's actually quite bullish. The only thing that is stopping me from being aggressively bullish, like looking at long stock opportunities immediately, is the fact that the climate on the S&P is still down. So in that sense, I would say that if we find long trades that we want to add, which in the case of my portfolio, I already got plenty of positive deltas. Okay, so it would not be a good idea for me. But let's say you don't have long positions in the portfolio and you want long positions. So for sure, in an aggressive way, because the climate is down, but you could certainly go ahead and start looking for long trades. At the same time, because the climate is still down, I would not do it without a hedge. So in other words, for every long, I would like to find a short in case the climate will continue progress to the downside. Okay, now if this climate had changed to blue, with the implied volatility higher for the calls and the puts, all of these different analyses we have done, beginning of a new wave on Elliott wave. So with all of those things in place, well, then yes, of course, that's a different story, and I would have no problem to get more aggressive when it comes to looking for long opportunities. Okay, so much more bullish day today compared to yesterday. But again, note of caution because the climate is still red, and therefore, at least in my trading plan, in my rules, if I was to get into long opportunities, because let's say you had a long trade and you close it today because you reached the target, so now you have too little positive deltas and you want more positive deltas, and you are looking for long stocks. Immediately, I would turn around and add a short opportunity to offset and have a little bit of a hedge on my account because of the risk of the down climate to expand further, even though statistically speaking is not supposed to do. But of course, we've seen that happen before, isn't it? Ahmed, how are you, my friend? Good to see you. Very nice. So this is what we have from a market analysis point of view. Again, anything could happen, really. And that's why, a note of caution with the climate. Also, the next red UFO is quite far. The next green UFO is quite far. So we can see price, trade from 458 all the way to 452 in an instant. Okay, this could happen. And then that would change many things because that would probably invalidate the wave. The Elliott wave probably, imply that the climate will continue. So again, something to, how do I put it? Something valid for us to be exposed to, but careful there with getting too overexcited too soon. Again, if you are a conservative trader like myself, and you're having this approach, okay. What else? VIX. So implied volatility yesterday was around 23. Today it's dropped to 21.69. Obviously, as the markets get more and more relaxed, so we got less and less premium. But 21 is not too bad. So we will be looking for non-directional opportunities. Okay, and if I show you my portfolio, the trades that we have, I have 39 positive delta. Okay, so it's almost everything is positive delta. Okay, so then and obviously shorting now, I don't see it as the highest probability ever, right? Beginning of a wave on the S&P, the climate that may change. So shorting now as a hedge, I'm okay, but entering short trades with this type of market environment, I will not be too happy. So then I don't want to add more positive delta. It's maybe not the right time to enter short delta. Therefore, a non-directional trade with a VIX of 21 plus, that's what I'm going to be looking at, which is kind of, continuation of what I started yesterday from a trade analysis point of view. So I'll be looking for iron condors and trades of that sort. Okay. When it comes to trade review, COF, again, I will not look at the risk profile graph. We saw that yesterday, so it's probably fresh in everyone's mind. So the S&P has been moving higher. So COF is also higher by 1.70%. Again, it doesn't really matter because we will need to reach 179, which is even above the chart, the whole chart, right, to reach peak performance, peak profitability. So that trade, as we saw yesterday, is likely going to end up as a profitable trade. But again, it's probably going to be $58 per contract, and that's it, end of the story. Yelp, a little bit of a breather today, if you wish. Even though we are still far from 38, okay, it's trading at 34 something. So pretty nice move, 1% up today. Again, we're going to be breaking even when we reach 38, more or less. So we still need that to happen. So far, again, there is nothing too much to comment on top of what we commented yesterday. Landmark Corporation, which is the next stock in line, 2% up today. That's powerful. It's pretty impressive, even though overall, if we look at the trade, we are still down here. Okay, we are still down here, even though it's at 2% up today. We started here, right? So the drop has been so significant that this trade is very likely going to end up as a full loss unless the stock really, really accelerates. And as the stock accelerates, then we start tweaking it. Okay, and we start butterflying it and things of that sort. Okay, so far we cannot do too much. Okay, and this is a real P&L. Okay, minus 220. Qualcomm. So Qualcomm has also been rallying 0.65% up. So again, this is already a butterfly. So let me see if something needs to be done here because that stock has been moving higher today. So okay, well, we are still in that area, but because the stock has been moving higher today, notice that statistics from now until February 18 are giving us this magenta line, which suggests that it is possible from the current price to get up all the way up that high, which is deep in the profit zone. So certainly happy to let that happen. If the S&P is going to change its climate, stocks are fragile. They depend on the sectors. They depend on the S&P. They depend on many things. So if the S&P is going to move up, most likely it's going to drag stocks with it. Qualcomm may be one of them, and then we can end up with a much nicer profit on this trade. So we are playing this one, which has a maximum risk of $30 at the moment. So we are just leaving it alone at this moment in time. Nothing new. And then finally, EOG. Nothing new really as well. So EOG is right here, and that stock gapped down today, okay, but then rallied up, is 0.67% up. So again, we need that stock to really, really drop for us to be able to profit, and so far it's just been moving extremely very much against us. So good news, risk is limited. There's a beauty of options in it. We have $95 of risk per contract. That was a hedging trade, went against us. Okay, well, that's what it is. Of course, if that stock falls, then we'll work on tweaking this bear put spread into something else, which may increase the odds of profitability or reduce the risk, or both. But so far, it's way too far from the entry in the opposite direction, and therefore there is nothing to be done but wait, and knowing that worst case we'll lose 95, which is okay. Cool. Okay, so I tried to do all of this review quickly. We managed to analyze the market and do the review in less than 15 minutes. I guess that's good. And therefore, we are now ready to begin our trading session. And we're going to continue from where we left yesterday. which was a session where we were looking at non-directional trades. Okay, and the way I was scanning yesterday is, I started with advanced option scan. I was looking at implied volatility greater than 80. We had no filtering conditions for stocks. We had we were using the penny increment options list, okay, which obviously when I do that, that may cut that list in much shorter, on only one stock, Yelp, and we have a trade on Yelp, so that one I wouldn't touch it. Then we got neutral zone for daily and neutral zone for weekly, okay, and then earnings at least 15 days from now, and then finally auto climate, everything is unchecked, okay. So in other words, we have our conditions that we normally use for non-directional type of trades. Of course, with only one result, there is not too much that we can do. So we are going to have to play with the various possibilities on the matrix to see if we can increase that list and find trading opportunities going from greater level of advantage or an edge, moving into a lesser greater of advantage, lesser edge. Okay, what's the greatest edge as possible for a non-directional trade? Well, is to have so much premium that even if the stock was to move against you, you wouldn't lose. Okay, that would be amazing. That of course never happens because that's too idealistic. But that's basically what I'm shooting for when I look at mean greater than 80. It means lots of premium in the options. That's why we only got one. Okay, so what's the second choice? Well, the second choice is to look at CAV mean minus historic volatility above 2 standard deviation. Okay, so this is maybe less extreme, but still a very interesting way to look at the markets. In this case, it's Akamai. We actually looked at that stock yesterday and it didn't work. So I guess that in order to save a little bit of time, probably I'll skip it today as well. But that would be the second method on how to look for high level of premium. And the third method I use, and by the way, you can change the sequence on how I use it. That's not the end of the world, but it's just my habit. And then the third method would be to look at top percent increase on the CIV mean in the last 5 days. Okay, and in this case, you would normally expect a few more. Notice how many of those symbols repeat from yesterday, okay, but some are not, such as MGM, for example. It was not there yesterday. Then JD was there yesterday, even though I was not too happy about it because we have multiple of the blue lines. Let me show that again. Multiple blue lines were beyond the red line, okay, which means that the implied volatility available on that stock may not justify the speed of movement the stock may generate. So in other words, the options are expensive indeed, or have been becoming quite expensive indeed, but given the speed at which the stock moves, may not be enough. Okay, and again, sometimes you get surprises. Okay, I mentioned that yesterday because some strike prices may have price anomalies, and then when you actually plan the trade, you realize that the reward to risk ratio and everything is good enough, and you can actually take the trade. So nothing wrong with checking, but again, I'm going to try or start with other methods, okay, with other stocks where in a perfect world, I wouldn't have that problem. So WPM, okay, Wheaton Precious Metals Corporation from Canada. So that one seems to be a bit more advantageous where the red line is not beyond the blue lines, but at least you can see it's, it's quite okay. Okay, it's not as disadvantageous as JD. And by the way, even if you didn't check that, okay, again, from an implied volatility point of view, is one of the stocks that has increased the implied volatility in a percentage basis the most in the last 5 days, right? So for sure, you are not selling cheap options. And if the premium is not enough to justify the risk, we will see that as we continue our analysis, okay? Now, WPM, it's not the most liquid option in the world, but they do have weekly expiration dates. Okay, so I'd like very quickly to take a peek at the levels of liquidity. For example, current price is 105, so we do 105. So we are dealing with 425, 430, or 510, 530, 650, 740. That's not too good if we go, well, that's 57 days from now, okay? And if I look at the front week, when I look at 28th of January, we're talking about 289 and 320. I feel it's just a bit too wide as a spread. So I'm gonna pass on this guy, okay? Oh, sorry guys, this is EOG. I was not looking at the WPM. Yeah, here we go. So let's look at WPM again. So 42, 101, 109, 86, 71. Okay, so this is indeed 10-cent spread. Yeah, this is potentially tradable. Okay, so okay, good. I feel better now. I'm not sure if I ever traded WPM, and if I did, it was a long time, so it was not fresh in my mind the level of liquidity I would find. Okay, so that's why I wanted to check that. Anyway, so when looking at that stock and we look at earnings, earnings are going to happen on March 10, meaning that we can use options that expire up to March 4. Thank you, Mark. Good eye, my friend. Good eye. You know, it's all about muscle memory in the end. I have multiple types of pages that I use for my own training, and this particular one page is the one I use for the sessions, because you know when I share my screen with you guys during the sessions, I share one screen, and also it's a specific resolution to fit well on YouTube and so on with full HD, where my other monitors are 4K with more resolution and stuff, and so some of my settings are a bit different, and that's why sometimes I make those mini silly mistakes. Okay, but I appreciate you guys are on top of me, so we keep each other accountable in different ways, and that's great. Thanks for that, Mark. So looking at the skew, okay, okay, and I'm gonna float it, I'm gonna group it, so then I have it for the next trades, and we got WPM here. Again, we said we can go all the way to March 4, so March 18 I'm gonna disable it, and all the other expiration dates I will enable them. I'll show calls and puts, okay, and let's do edge strikes, for example. So major price anomalies there, okay, major price anomalies in certain cases. Clearly, the red color one is the winner, as it normally is. Okay, the red color one is the winner, okay, which is the front wick. If I add the second one, it's a bit less of a problem, but notice how there is huge price anomalies there, where those puts become so expensive and those calls become so cheap. This is actually very good for the trade, because you want to sell options out of the money, and if out of the money those puts are going to be so expensive, that's actually a nice thing to see. So we'll keep February 4 as a valid expiration date to check. 11 has a similar behavior and is very similar to the prior expiration dates from a volatility standpoint. So pretty cool. I'm happy to see this, because often when you go 2, 3, 4 expiration dates away, then volatility drops a lot, and in this case it kind of like it's maintained, so that gives me more choices. Same with February 18, February 25 as well, and March 04. Oh, March 04 actually looks better than February 25. Yeah. Anyway, in this case, to be honest, it's very difficult to decide which one is best, so I'm just gonna go with all of them all the way to March 04. It's gonna be just a little bit more time spent on the spread select, which will be worth it if we find the trade that we need. So let's begin. We said we're going to use 28, February 4, February 18, 25, and March 4. Okay, so multiple analysis to be done here. I use the skew tool often to save a little bit of time on this process, so I don't need to check all expiration dates. I only check the best. But in this case, that's what it is. So we have $40 stock, so I'd like to use $1 strike price increment, maximum 2. That's fine. And we're gonna enable our filter, and we're gonna build 99 spreads. I am not sure why it's not filtering. Oh, of course it's not filtering, because I didn't add the template for the filter. Okay, so adding the template for iron condor parameters. Here we go. Now we have it. So we're gonna filter, and we have a bunch of passes starting on February 11. We got 3. So 47, 45, 44, 44. So let's go ahead and take a look at the chart to find out, using February 2028. Okay, remember, is the light blue line is the more extreme case. So we got 44, almost 45, 39. Okay, 39 something. So 44, almost 45. So I would say this one is valid. 45.28, and then 38 is also less than 39, so that's fine. And the one below 47.38 is also fine. Both are good. From maximum profit, we got 28.25, and therefore the one above provides a 38% rate of return instead of 33. So I guess it's pretty obvious that this one is better. Selling 39, buying 38, selling 45, buying 46. Spreads are okay, and therefore I'm gonna go ahead and graph it because it seems that this trade would meet our conditions. Okay, so I'm gonna leave it there. Okay, and come back in a moment. What else? Well, uh, sorry guys, that was February 11. Okay, February 11. Okay, was not January 28. Okay, February 11. So we are talking about this one. Okay, that's going to change everything because now, actually, not that much. Still, I think we may still have a shot. So 46.5 and 47.58. Okay, 46.5 and 37.58. So 47, 47 and 38. Yeah, the bottom part is not 38, is 37.6. Okay, yeah, so that one wouldn't work. Almost, but it wouldn't. Okay, it wouldn't work. And we started here all the way with February 11, which means that the other ones are not meeting our rules. So let's check with February 18, 25, and March 4 if any of this is going to work. So we have a few passes. With February 18, we have 4 passes. Okay, 45, 46, 45, 46. I don't think this is going to work because 47 is more than 45, isn't it? So the statistical range is more than what February 18 is going to provide. This, by the way, is something that you will often see, which is monthly expiration dates. February 18 is monthly, often have less spice built in. Okay. So yeah, so keep that in mind. And we are going to go ahead and redo it. With February 25 and March 4, we have different possibilities. So February 25, well, I'm not sure what I've done there. I have hit copy and paste. Okay, so with February 25 right here, so we are dealing with 47.8 and 36.7. Okay, so 47.8, 36.7. Let's start with the 47.8. So we got 48. Okay, so that's fine. And then 37.5 is 36.38. So that wouldn't work. We need 36s. We don't have 36s anywhere using February 25. So the last one left, it's March 4. Okay, March 4 is the last one left. You guys are very silent, which is understandable. But again, if there is anything you want to comment, let me know. And no, this is not going to work because the maximum point is 45, 46, 45, 45, 46. So that's not going to be enough. Okay, that's not going to be enough. And therefore, the WPM will not be a valid candidate for us to execute an Aaron Condor on it. Okay, so the next one in line is MGM, which is another stock I have not checked yesterday. That we didn't have it in the list yesterday, but we do today. So let's find out. Earnings for MGM are happening on February 9. So we can go all the way to February 4. In this case, it's only 2 expiration dates. So I'm just going to check both and that's it. On this case as well, we can see how the red line is beyond any other line. So this is something that, as discussed yesterday or earlier today, something I indeed appreciate. And therefore, we're going to now go ahead and take a look at MGM, looking at January 28 and February 4 only. Okay, this is another $40+ stock. So 1 to 2, maximum risk $2 per contract, $200 per contract. And with that said, we're going to start building iron condors. And now we're going to be able to sort it and see if anything passes. It seems that using February 4, we got 2 cases that pass. Everything else does not pass. So let's take a look at February 4 and find out our limits, which are 48 and 38 something. Okay, so 48 and 38 something, which unfortunately the break-evens are 46 and 46. So it's not meeting our 48 demand. In this sense, MGM will not be a valid candidate. Okay, and also that stock is up by 2.3%. So of course, implied volatility, it's probably dropping as we speak in many of those strikes. And therefore that's the other reason. Okay, so now therefore I'm going to continue working on this list. I got JD here. Okay, JD is a $79 stock. So when looking at here, we have this problem again. So again, this problem is just a bit too exaggerated, too many blue lines beyond the red line. I mean, I know what's going to happen. I'm going to do the analysis and we're going to basically waste our time. So I'm not going to do it, even though sometimes you may have surprises, but SPG is not liquid enough in most cases. FDX, let's take a look at FDX. So FDX got one line, okay, beyond. So let's take a look at what this could be. So we are talking about earnings on 317. So maximum expiration date to use would be 304. So let's look at all of these. The skew will start with 28, okay? From there, we'll move to February 4, which is a bit less, but there are some strikes with price anomaly bringing in more premium, so I'll keep that one. The next one happens to be almost all the time below the prior two ones, even though it's a further expiration date. So that's not so interesting to me. I'll keep it as a reference. I'll come back to this one. Then the next one, it's similar to the green. February 25, it's below, and March 4th, that one is above. Okay, so what I'm going to do is I'm going to remove the February ones, okay, and I'm just going to keep either January 28, February 4, or then I'm going to move all the way to March 4. Those are the expiration dates that seem to be the most interesting out of looking at the skew. So with that said, let's go ahead and set this up here. So we said January 28, February 9, and February 4 and March 4. Okay, so we are going to readjust this. This is a $255 stock, minimum strike price increment 2.5. So we'll go from 2.5 to 5. And with that in place, let's build 99 spreads and sort the filter. So we have some passing conditions starting with January 28. So let's find out more about January 28. What's the expectation for January 28? The expectation is with the second blue color, 267.8, 243. So 267.8, we don't have any. It goes all the way to 263. So that's not good enough. So January 28, we're going to get rid of it. Okay. We are now looking at other expiration starting with February 4. We have many passes here, many passes. So let's see if February 4 is going to work. So February 4 suggests a range between 272 something to, let's call it 239. So 272 something to 239 to 272, looking down to 68, 261, 273. Okay, so 273, that's fine. But the bottom part is 241. And we said we need we said that we need 239. Okay, 239, and we got 241. So this is not good. 275, 241, same problem. So yeah, and that's the end of February 4, because here is the beginning of March 4. Okay, so if this is gonna work, it's looking like it's gonna be March 4. So let's reassess. Okay, March 4. We have a few passes. So March 4 requires us to be taking into consideration a range between 276 to 235. Okay, so 276, 235. So 276 and 235. It seems that we have one here that passes. Liquidity is not the best in the world, but we'll come back to this in a moment. For now, I'm just going to capture it here. So I come back to this. So 276 to 228. That one is 29%. That one seems to be better. So I'm just going to capture it and we'll talk about it later. Let me float it. Let me float it. We said the bottom part 230, 235 and 276 something. Okay, so let's come back here. Maybe there are more. 275 and 233. That one provides 38%. I sense a bit more liquidity as well here. So let's analyze this one. And then I have here 281, 233. That would also work. That would also work. So let's assess that one too. Okay. So total, we got 4 guys. Okay. So let me go ahead and let's try to be as visual as possible as I can for you guys. So you have 1, 2, 3, 4. And we're gonna put this one here. Okay. We're gonna put this one here. We're gonna put this one here. And we're gonna put this one here. Okay, so we have 4 risk graphs, which are 4 possible trades for us to take care of. So now let's first focus on break-even points to reconfirm. We got 276. We got 276 something. We got 281, and we got 276. So of course, from a safety net point of view, the 281 is indeed a better choice. Then on the bottom part, we got 233, 228, 223, and 233. Okay, so then again, from a safety net point of view, the 223 is the best choice, while on the upper part, the 281 is the best choice. Okay, so in other words, the other 2 trades, unless we change our mind, they're going to be, or they're supposed to be, less advantageous. So I'm going to get rid of them. And now we can compare these 2 guys. Okay, we can compare these 2 guys right here and right here. And now we can compare other parameters. Okay. Okay. So liquidity. So 71 to 101. This is like 30 cents of difference. 147 to 188. That's like 40 cents of difference. I'm really rounding figures here, but it's 40 cents out of $1 plus, versus here is 30 cents of less than $1. So it's more or less the same when it comes to liquidity. Here we got 107 to 136. Again, another more or less 30 cents. 214 to 249, another more or less 30 cents. 112 to 137, that's more like 20 cents. 173 to 205, that's more like 30 cents. 112 to 137 is like 20. 74 to 89 is more like 15. So it looks to me like the the values that we find on the right are just a bit more liquid. Also, I'm looking at volume of 100 contracts, so 100 contracts were traded here, where here it's only 11, and here 2. So I mean, it's not like this is the most liquid expiration date. March 4 is obviously not a monthly expiration date. It's not the most liquid in the world, but it seems that we may have a little bit of an extra advantage at getting filled if we work on the trade from the right, and that would provide a little bit of a greater advantage to the upside, instead of the downside. Even though the downside is, I would say, pretty okay, because we got here, let's call it 234, where when looking at the chart again with March 4, okay, statistics suggest 234, 235.5, meaning that we have more premium to defend ourselves beyond that. Apart from now looking for the UFOs and everything else, so I'm okay with that. Okay, and therefore this would be the trade that I would like to propose for us to focus on, the one with a break-even point going to 281 to 233, 234. Okay, that would be the trade. The credit collected on this trade, if we get filled at the midpoint, would be $106.5, and the risk of the trade would be 393.5. Is $5 of strike price increment, right? And we get paid 100 plus. So then the net risk left, it's a little under $400 per contract. So this is the trade that we are talking about. Now, going back to the chart, let's apply our method now, because looking at the option strategy is extremely needed, powerful, and relevant. But then if the stock goes crazy up and down because there is nothing to stop it, then your non-directional trade now is going to fail, because the stock is not behaving non-directional, is behaving strongly impulsive, and then that's going to be a big problem. So we want to limit the damage that we may receive if that stock was to start moving like crazy. Okay, so in that sense, we're going to look at March 4. I'm going to put my mouse here and draw a line all the way to today. Same here with March 4. So we are defining the statistical extremes from a range point of view for this trade. Okay, and now that we do this, we're going to drop to a lower time frame, looking for UFOs above and below. And we also have a requirement for those UFOs. We want them to provide at least 42% probability. These ones provide 52, which is great. So let's see if we can find UFOs either above or below our line. I don't have UFOs above. I do have UFOs below. And guess what? The reason why I may not have UFOs above, you know what? I do. They are so far away. Okay, so this is not ideal, okay? Because it's going to create such a wide zone above price. Okay, so I'm going to look for a solution for this in a moment. But so far, I'm going to draw a proper line there, setting the top of the range. I'm going to approve this as a top of the range, even though I don't like it, and you will see why in a moment. And the reason why I'm going to approve it for now temporarily is because we got at least 2 UFOs above. We got 1, 2, 3, 4, and then 5. Okay, so our rule is minimum 2. We got many more. Okay, so thank you very much. On the bottom part, I am way happier. Why? Because the UFO below our red line is nearer. Okay, it's nearer, and therefore it's creating an unknown zone, which is narrower. And also, in case we're going to be wrong in the end, so we have tools for us to act on the trade sooner, because the purple line is closer to the statistical range. Okay, so I'm way happier with the bottom part compared to the top part. Also, if I approve the trade the way it is now, well, because the distance between the red and the purple lines above is much greater, so next thing you know, the current price of that stock, it's not well centered in the range. That's not the end of the world, but it's indeed not ideal. Okay, so I would like to revisit that by looking other expiration dates, looking at other time frames, such as 89, and see if I have UFOs there that I could use instead of using the 55-minute time frame. Okay, so let's see. Do we have anything else? Well, look at that. We have a UFO there. Oh, it's 47.83, so that is something I will not accept. So then we're going to move to 144, which is the next time frame. Okay, and then no, we got UFOs, but they're above the purple line. I'm looking for UFOs below the purple line. We have 233. So let's see. Okay, here we go, and that is way better. Okay, that is way better now because I have UFOs right here. I could adjust my line to be here. Now I'm relying on this UFO. Okay, 54% probability. We got multiple UFOs. Okay, so that's much better. Um, I'm still gonna take a look and see if I can narrow this a bit more, okay, because again, the distance between here and here is more than the distance between here and here, as you can see. So in order to do that, I was using the 55-minute time frame. So now I'm gonna go down to 34. I still get the probabilities I need, 52%. So now looking above the red line, I have a UFO there with 52% probabilities. So I could go here. Still feels like pretty wide distance between the red and the purple compared to the bottom part, as you can see. Okay, so I'm gonna look at the 21-minute time frame and I'm gonna stop it there. Okay, 54%. So this is good. Yeah, and the 21-minute time frame UFO coincides with the 34. Okay, so that's how well I can do it. Okay, now of course another choice I have is, if I want to make it more equal distance, I could certainly go ahead and adjust my bottom part as long as I have UFOs, which I do. I could adjust my bottom part maybe to be here, and now I'm going to be slightly more centered in the range. Okay, so I would say this is probably a much more ideal setup. Okay, so coming back to the daily time frame, so this is what we have. Okay, coming back to the daily time frame, this is what we have. What we have is a range, okay, from now, which is here, right there, from now all the way to March 4 expiration. So this is the whole trading range that we're exploiting, even though for this trade to end up as a profitable trade, okay, let me do this right, okay, really the range that we need to capture, sorry, not the range. I mean, to be honest, there is a bit more wiggle room, but in a perfect world, okay, for this trade to be profitable, you would want it to stay here in this box, knowing that you have a little bit of extra space all the way to 281 and 233, okay, which is a bit above, a bit below, and this would give you a little bit more of a breather, okay. But this is kind of like the ideal zone where you want the price to stay during that period. So now, of course, if price was to rally and come in here, there are UFOs likely to bring the price down. If price was to come in here, there are UFOs likely going to bring the price back up, which is where we want to be. If not, we have rules in which we're going to act in order to manage the trade and be able to tweak it to improve its performance in case the market was to move against us. Okay, as we have done many other things. Okay, so anyway, I would say this is the trade that we're going to execute. So again, 280, 285, 235, 230 using March 4. And therefore, I'm just going to put the trade in place using FedEx Corporation March 9. We are going to right click to sell Iron Condor. And again, double checking everything. So on the upper side, we said 80 and 85. Okay, 80 and 85. Let me double check that. Call side 80 and 85, March 4. On the put side, 35 and 30. So put side 35 and 30. Here we go. And that is suggested to collect a credit of 115. Real time, it looks more like 103. Let's see what we get. I'm just going to place the order now, and then I'm likely going to rectify it. So selling an around Condor for 115. Send. Let's see if I get filled or not. Okay, so just waiting there. I'm just going to replace it. I'll make it 110 to see if we get that. And if any of you are taking this trade and you get filled, please share it on the chat box, as it's very useful for the community. So you help each other to do a little bit of price discovery. So 110, 115. Again, I'm not surprised we're not being filled because, again, March 4 was not the most liquid option in the world. And second, even though here it says 115, the real pricing is showing more like 1 point something, one little, okay, not 110. So I'm going to try 105 now. Okay, still not filled. It says 0.99 real time right now. So I guess I'm going to have to change it again. And we may get one. Of course, I'm doing these things quite quickly because I want to get those stretch fields, even if it's not an ideal price. So in future sessions, I can work on them and help you. But when you do this in your real account, you want to give it a little bit of time to see if you get filled. Don't rush it too much, okay? Yeah, Joe. I hear, my friend, every time we put orders in, the bid goes way down. You are correct. You are correct. Actually, the ask price is what goes down. Sorry, you said it correctly. The bid price goes down. And the reason why this is happening is because, market makers have very intelligent technology where they are assessing orders coming in. They are kind of like comparing that information when it comes to the size of those orders coming in with the amount of liquidity available, the current bid size, ask size, bid prices, ask prices, and so on. And of course, they try to, they make a living out of doing that, right? So they try to readjust their bids and asks. So if they get filled, they understand they're going to make a more likely profit thanks to our trades. So, when a stock or ETF is amazingly liquid, for example, SPY is an ETF, you don't get to see that effect. But at the same time, you also get much less premium because so many more people have sold before you that then you may not get that level of premium. Okay, so there is a reason why there are times where some options chains are very cheap or very expensive. And many times, a little bit of lack of liquidity actually helps to get better pricing. But then you have to fight it on the execution. And that means that you need to be patient, okay? So anyway, I'm going to replace it with 0.95 and see if I get it this time. Hopefully I do. It seems that I didn't. So I'm going to replace it again because I want to have it. I need it for the following weeks. Especially this is a one that is exciting to me as your coach here because we're going to talk about this trade for multiple weeks. There may be opportunities to tweak it and so on. And these are very good learning opportunities for you guys. So when we do an Aaron Condor for 1 week long, basically it's you're right, you're wrong. That's it. But when we do it for a much shorter period of time, so to me, it's more interesting from a coaching angle, okay? Well, it's really fighting us, isn't it? What's the real time price now? 1. Okay, it's back to 1. And the bid is 88. So I'm using 90. So let's try 85. And I would say I should get it now. Let's see. And If not, I'm going to have to leave it there and try again. Okay. Anyway, in the meantime, what I'm going to do is I'm just going to copy this position to the clipboard. I'm going to go ahead and add it to top and open the positions panel. I move this down here. Remember yesterday we talked about the fact that maybe we were going to revisit FedEx, but guess what we did? The level of premium yesterday was found in the February expiration, funnily enough, but not today. We tried February, but it didn't work. So we ended up using March 4. Okay, now even though liquidity is giving us a little bit of time to get filled. Okay. Yes, Mark. I mean, in a normal world of options traders, you would all see the same quotes, unless your broker is not giving you, for whatever reason, the same feed or something like that. Which, when it comes to executing a trade, that would be very bad. When it comes to charting, it's a different story. When it comes to the prices you see when you place an order, since we are dealing with exchange traded options, everyone should see the same. Okay, maybe since we got only 5 minutes before the session is over, I'll just wait and on one hand see if we get filled or not, and on the other hand, I'll make an extra comment about getting filled and all of that because it's irrelevant. I don't have time in 5 minutes to find a new trade. Yeah, so let me explain this. With options trading, we have multiple exchanges out there where your orders may get filled. The classical exchange is the CBOE in Chicago, but there are more. So when you place a limit orders, there may be times where your limit orders get stuck somewhere, because a limit order is an order that is now residing in some exchange. Okay, a limit order does not reside on your broker. Okay, so if I was to place an order with Thinkorswim, and I was to, instead of, let's say, I'm not going to replace it, okay, but let's pretend I do this. So instead of using a limit order, which is what I'm doing now, I was to use a market order. And then I was to give it a price condition, which is if FedEx drops to whatever price, then take the trade. So then the order is residing in my broker until the condition is met, and then is sent as a market order. So then it will be executed immediately in whatever exchange at whatever price. But the moment you don't do a triggering condition like that, the moment you use a limit order, which is what we normally do, that order would be sent to one of the various exchanges available, and that one exchange, would be selected by your broker. So, I mean, if your broker is 100% fair, they will send it where they find, or the field you have the greater probability of being filled. Maybe where the bid size is the greatest, maybe where, maybe prior trades have occurred at this price already, where other exchanges maybe not. So something like that. And they may route the order there. Of course, there is also a different story where some exchanges may be more motivated to route your traffic to, some brokers may be motivated to route your traffic to some exchanges because they get payment for order flow or other benefits. And then, they may send your order there, even though it may not be the most advantageous place on where to be for you to get filled. That's why sometimes different brokers get you filled in a more efficient way or less efficient way. Okay. But in any case, so once your order is sent, okay, like in my case, I got an order with 85 cents, then that order is residing in that one exchange. And let's say my broker is the best in the world and did the best assessment possible, and he's like, okay, the greatest probability of being filled is in exchange ABC, so that's where the order goes. But then I'm not getting filled. And then let's say the market moves in other exchanges. If the market moves in other exchanges, you would see it reflected here. You would see it reflected here because your broker gets the feeds from all the exchanges. But while you would see it reflected here, right, and you may see at some point a price good enough for your order to get filled, you may still not get filled. Why? Because maybe that price improvement that happened, we just got filled at 105 finally. So that price improvement that just happened may have happened in another exchange where your order is not. And because it's a limit order, that order is already residing in exchange ABC. And therefore, it may take even more patience for you now to wait until that other exchange also moves price, and then finally you get filled. Again, when you trade liquid assets, normally the amount of patience needed for this to happen is not that much, but there is a level of patience there, not only to wait to get the right price, not only to kind of be tolerant by the fact that as you place orders, the bid and the ask prices may move because you place an order if your asset is not the most liquid in the world or the expiration date you selected. But on top of that, there is even more patience to add when your order may get stuck in some exchange. When I say get stuck, it's not like it's stuck, it's just waiting to get filled. But maybe that exchange they don't have the market participants that were willing to buy at a lower price yet, and therefore you could not sell buying at a higher price, and therefore you could not sell at the price you wanted. Okay. Here you can see, for example, Mark got filled at 104, and Ahmed is still waiting to get filled. Now, I'm not sure if you guys were using the same price of 104 or you were trying different prices, but assuming you were using the same price, you would think, how come? Well, apart from the liquidity aspect that, for every buyer, there may or may not be a seller. For every seller, there may or may not be a buyer. Okay, there is not equal amount of buyers and sellers at every moment in time. That's the laws of supply and demand that affect everything in life. A part of that is that you may have, Ahmed, your order in some exchange where Mark had it in another exchange after the broker sent it. So that could be the reason. And again, I wanted to add that comment. Not sure if you guys have experienced that before. Not sure if you knew that was the case. Not sure if you ever had a chat. Jeff got filled at 105. Very nice, Jeff. Not sure if you guys ever had some experience of that sort when trading options before, and maybe you call the trade desk and you said, hey, how come I see the bid price is 105 and I have an order to sell and I'm not getting filled, right? How come? And the reason is because it's 105, but only in some exchange, not in all exchanges. Okay, and your order may be in the other exchange. So please feel free to comment on that. We are about to conclude the session here, but feel free to comment on that because I'd like to know if this ever happened to you or not. In the meantime, I'm going to document this trade properly. So we got 113 for the 280 call. So let me come back here. So 280 call, we got 113. For the 285, we got 73. So 285, 73. For the 235 put, 248. $248. And I believe the last one was 183, if I'm not mistaken. Am I right or wrong here? 183, 248, 183. Yeah, I got it right. Okay, perfect. That's it. So that is the trade, my friends. This was the day of the entry, which is today. This was the price at which the stock was trading at when we entered. And we will be monitoring this and see what happened with this trade. Okay? Very good, everybody. My pleasure to conduct the session for you guys, and my pleasure, and looking forward to seeing you on Sunday when we do the top session. See you then. Keep up the good work, and talk to you all soon. Bye-bye, everybody. Take care. Thanks for joining me today, my friends. Bye-bye.